We just finished going through Arista Networks 2026 Q2 earnings call materials, and now we want to share our takeaways with everyone. Here's a number to sit with. This company just did more revenue in one quarter than it did in the entire year of 2021. First quarter ever above $3 billion, and they raised the full year target for the third time in 9 months. Now, don't celebrate yet, because the thing capping this business isn't demand and it isn't competition. Let me show you what it actually is, because it changes how you read every number in this deck. Two numbers frame this entire quarter, so let's put them side by side. On the demand side, revenue came in above $3 billion, up 37.7% year over year, and the deck points out that Arista's total revenue for all of 2021 was $2.9 billion. One quarter now beats a full year from 5 years ago, and I'm telling you, that's a slope change, not a good quarter. On the supply side, full year 2026 guidance is $12.6 billion, upgraded for the third time in 9 months, up 40% year over year. And here's the CFO quote that reframes everything. Guidance is based on the supply we have confidence in getting. Read that again, because it means the number they printed is not a demand forecast at all. The red here is that the growth ceiling isn't competition and it isn't customer appetite. It's purely component procurement. That's a completely different problem than the one most people are pricing, and it shows up on every page from here. So what are customers actually buying? And why can't they just buy something cheaper? The deck frames it around one brutal fact. Training a large model needs tens of thousands of chips working synchronously, and a single drop packet halts the entire expensive cluster. When your compute costs 6 figures per chip, an idle minute is real money burning, and that's the whole value proposition. The company's operating system, EOS, is what enforces that, and the deck says it delivers security without sacrificing a single minute of compute cycles. On hardware, the 7800 AI spine allows massive cluster scaling without adding expensive, power-hungry network tiers. The newest release this quarter is the 7060XE7 with 100 terabit capacity and 1.6 terabit throughput, and it carries Arista's first liquid cooling options. And the adoption number is the one-eyed circle. Etherlink customers went from 4 or 5 early adopters to more than 100 deployments today. 4 or 5 to over 100 is not a pilot program anymore. That's a product that crossed over. Now here's the map you need, because this company does not win everywhere, and the deck is honest about that. There are 3 distances in an AI data center, and each one is a separate fight. Scale up is inside the rack, 2 to 3 meters, and the deck labels it conceded territory. We live in an NVDA world, and Arista acknowledges minimal participation against NVLink's vertical stack. Scale out is inside the cluster, across the data hall, connecting hundreds of racks into a cohesive AI cluster with Ethernet leaf spine architectures, and that's called Arista's traditional stronghold. Scale across is data center to data center, city to city, and the deck calls it the power-driven frontier. The reason it exists is the one nobody planned for. Customers cannot secure enough localized power, so AI infrastructure is forced to distribute geographically. And the CEO explicitly rejected the idea that this is temporary. Our read is that conceding the rack while owning the 2 longer distances is a defensible place to stand, as long as those 2 layers hold their premium. Let's go through the scorecard, because this is a genuinely blockbuster print. Revenue above $3.0 billion beat their own $2.8 billion internal guide, and it's the first single quarter ever crossing the $3 billion mark. Operating margin came in at 49.9%, and the deck makes the point directly. A hardware company operating at 50% margins highlights the hidden premium of the EOS software. Diluted EPS was $102, up 39.7% year over year from 73 cents. International mix jumped to 23% from 13.5% last quarter, driven by organic growth and geo-shifting of major global accounts. Cash and liquidity sits at $13.3 billion with operating cash flow of $1.1 billion, and notably no buybacks were executed this quarter. The one Blemishes gross margin at 63.4%, down from 65.6% a year ago. And the deck says that contraction is driven purely by customer mix and early supply chain costs. No buybacks while cash piles up tells you something about where they'd rather put the money, and the next few pages explain exactly where. So watch this staircase, because the shape of it matters more than any single number. The analyst day target was $10.5 billion. That went to $11.5 billion by May 2026, and now it sits at $12.6 billion as of August, up 40% year over year. That's plus $1.0 billion, then plus another $1.1 billion, 3 upgrades in 9 months. The CEO confirmed where the latest $1.1 billion came from: core data center front end enterprise and routing. So the raise isn't one lucky AI order, it's spread across the boring parts of the business too. And I'd argue that's the healthier version. Now the deck flags something I appreciate, a target discrepancy right out in the open. The CEO said the 2026 overall AI target is at least 3.6 billion, while the CFO said AI fabrics are at least 3.5 billion, and the deck presents both unreconciled numbers to highlight shifting internal boundary definitions. That's a small thing, but definitions that drift are worth watching because they make year-over-year comparisons slippery later. This is the most interesting new market in the whole deck, and it exists for a reason nobody wanted. The scale across market is $3.0 to $4.0 billion today in 2026, and the deck projects 15 to 20 billion by 2030, inclusive of optics. Arista's cut today is roughly 1.2 billion, which is about 30% of their total AI target, and the deck's insight is that they're taking a massive share of a nascent market driven by cloud giants now bleeding into neo clouds. Here's the mechanism, and it's almost funny. AI can't find enough electricity in one place, so it spreads out across cities, and spreading out means somebody has to connect those buildings. The math the deck gives is that maximum scale equals network tiers times radix, meaning ports per device. Using a high radix 7800 spine reduces the number of tiers required, and fewer tiers don't just save hardware cost, they save massive amounts of electricity. In a power-constrained market, energy efficiency dictates network topology, and that's a moat you can't undercut on price alone. Let's get specific about the software, because moat is a word people throw around without evidence. The deck gives 3 mechanisms, and each one maps to money. Smart System Upgrade lets them upgrade switch software without halting service, which matters because AI environments require constant security patching, and it prevents full cluster reboots and lost compute cycles. Multi-path reliable connectivity deals with a problem legacy networks have. Packets forced down single paths cause hash collisions, so MRC sprays packets across multiple paths and reassembles them, which recovers lost performance and wasted GPU time. Segment routing tags packets with designated segment IDs and dynamically moves traffic away from instantaneous congestion. And the deck says it unifies scale out and scale across routing under a single EOS brain. That last line is the one that matters. A feat piecemeal white box hardware cannot replicate. Our read is that all 3 of these are really the same claim wearing different clothes, which is that idle expensive compute is the real cost and software is what prevents it. Now let's Steelman the other side properly, because the white box argument is not stupid. On capital expenditure, white box wins outright with ultra low initial hardware cost, while Arista charges premium pricing for integrated systems. The deck's counter is on operating expenditure. Arista claims high automation requiring 0 to minimal networking headcount, while white box requires massive, highly skilled internal network engineering teams to maintain, integrate, and patch. On reliability, system-level diagnostics prevent mid-cluster blowouts versus a high risk of isolated component failure halting entire AI jobs. And here's the CEO's own verdict, which is refreshingly not a sales pitch. White box will win where customers are highly price sensitive and already have massive internal engineering teams, the so-called Titan accounts. But for neo clouds with 0 networking headcount, the premium pays for itself in operating expense savings. Admitting you lose a customer segment is how you make the rest of the claim believable, and I'd give that a lot of weight. If you only remember one number from this entire deck, make it this one. Purchase commitments went from $3.6 billion a year ago to $9.7 billion today, nearly a 3x surge, and it's locked against 2026 and 2027 production. Break down what they actually locked. Memory is secured completely for 2026 across DDR4, DDR5, and NAND, with visibility extending into 2027, and manufacturing capacity for boards and optics is fully mapped within a rolling 12-month window. For liquid cooling, they built an entirely new supply chain from scratch, cold plates, quick disconnects, manifolds, and the geographic footprint is 3 foundries and 3 distribution hubs dispersed across the US, Asia, and Mexico. Think about booking an entire restaurant a year out. You only do that if you already know the guests are coming. The deck's own synthesis says it plainly. A company does not wager $9.7 billion on non-existent demand. This procurement surge is purchasing the right to ship in 2027. That's the strongest forward signal in the deck, and it's a signal you can verify, not a promise. Now the deck does something I always like, which is reading the tone rather than just the numbers. First quote. This is a 2-year problem for the whole industry. We won't exit this shortage until 2028. The red is that delivering bad news on top of a 37% growth quarter builds immense credibility, while quietly managing Wall Street's expectations for future guidance hikes. Second quote, we live in an NVIDIA world. Arista's participation in scale-up is very minimal. The read is that this frames weakness as a timeline issue, And the CEO immediately noted InfiniBand historically took 2 to 3 years to displace, so scale up is a multi-year war, not a permanently lost battle. I'd flag that one as management's most convenient framing, and it's the claim I'd hold most loosely. Third quote, first ever $3 billion quarter. In 2021, we did $2.9 billion for the entire year. The read is that management is aggressively framing this not as a cyclical peak, but as the permanent new baseline of an AI super cycle. Sometimes what management refuses to answer tells you more than what they do, and there were 2 of those here. First, analysts asked 4 separate times for the identity of the new Q4 customer driving a revenue bump. Management's shield was that Microsoft and Meta remain the longest partners, that they fully expect 1, maybe 2 10% customers, and then quote, I'll leave it at that to preserve flexibility. 4 times asked, 4 times deflected. Second, an analyst pointed to an upcoming September 8th webinar with Anthropic, explicitly asking about AI lab progress, and management deflected the entire response into a generic discussion about cybersecurity, avoiding the customer status completely. The deck's takeaway is that complete evasion usually signifies tight NDAs and unsigned contracts rather than lost deals. To be fair, that's a charitable read, and I think it's probably right, but it is still the charitable read. Either way, the identity of that customer stays a black box until earnings actually land, so don't model it as certain. Every blowout quarter deserves a look under the hood, and the deck runs 3 checks on itself. Deferred revenue spiked, with total deferred surging to roughly $6.9 billion and product deferred up $600 million in a single quarter, driven by new product ramps, new customer wins, and highly specific customer acceptance terms. Management warned this metric will remain volatile independent of underlying business drivers, which is a polite way of saying don't read a trend into it. Days sales outstanding rose from 64 to 68 days and inventory crept from 2.4 to 2.5 billion, described as necessary padding in a tight supply environment. Gross margin went from 65.6% to 63.4%, driven purely by customer mix. And here's the detail I'd underline. The CFO explicitly stated no price increases are factored into current guidance, and pricing power won't reflect until end of year or 2027 as older backlog clears. So they're eating costs now and can only price later, which means the margin throw is a timing problem, assuming the pricing actually arrives. Let's be honest about what can break here, because the deck lists 4 and none of them are trivial. 1. The supply ceiling. The growth ceiling is held by suppliers, not by Arista, and with visibility limited to 2 quarters and industry shortages extending to 2028. The revenue cap is externally controlled. 2. The $9.7 billion commitment is a double-edged sword. If the AI capital spending cycle cools before that capacity is deployed, a strategic asset instantly becomes balance sheet baggage. 3. Margin lag. Cost first and price later. Full-year gross margin guidance of 62 to 64% bakes in expected cost spikes in memory and silicon, and they can't immediately raise prices while working through older backlog. 4. Scale-up lockout. NVLink dominates the intra-rack layer. Displacing it is a multi-year war, and Arista stays highly dependent on the other 2 layers holding their premium. Risk 2 is the one I'd lose sleep over, because the same commitment that proves confidence is exactly what turns into dead weight if the cycle turns early. That single decision is both the bull case and the bear case, which is rare and worth respecting. Here's the scorecard for the next year, and it's tiered, which I like. The primary signals sit on the supply and demand axis. If the $12.6 billion target goes up a 4th time, that mathematically proves supply bottlenecks are loosening, and gross margin must hold the upper half of the 62 to 64% range, because dipping to 62% signals costs are outrunning product mix. Also watch the deferred versus recognized ratio. If deferred keeps spiking while top line growth decelerates, shipments are stalling at customer acceptance. The secondary signals are product and customer. Does that 10% mega customer actually materialize on the annual filing? Does the 1.6 terabit rollout hold its timeline of second half 2026 trials into 2027 volume production? And does scale across grow beyond its current 30% share of the AI target? The tertiary signal is whether they can maintain that 23% international mix or whether it reverts toward 13%. That's a checkable list, and honestly a fairer one than most companies hand you. Let's pull it together, because the deck's closing argument is a genuine reframe. The core question around this company has fundamentally changed. It's no longer Ethernet versus InfiniBand, and it's no longer EOS versus white box. With a 49.9% operating margin and Etherlink customers surpassing 100, the deck argues the demand debate is settled, and the only question that matters now is procurement. On the Moat, the scale across market isn't described as a temporary architectural fad. It's called a permanent $15 billion plus reality birthed by structural power grid limitations. As long as AI cannot find enough centralized electricity, routing dominance stays critical. And the final takeaway is to look past the $3 billion revenue beat and focus on the $9.7 billion purchase commitment, because in an AI super cycle, supply chain execution is the ultimate moat. Alright, last thing, radar always leaves you a light. I'm calling this one yellow. The business is flat out impressive. A hardware company printing 50% operating margins is not a normal thing. And I'm about 75% on the demand story being exactly as strong as they say. What keeps me on the fence is that the revenue cap is externally controlled by suppliers through 2028, and that they're eating costs now while pricing power doesn't show up until 2027. Growth you can't control the timing of is still growth, but it's the kind that surprises you in both directions. If they hike that $12.6 billion target a fourth time and gross margin holds the upper half of the 62 to 64% range, I flip to green, and I'm telling you that up front. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.